The stock price for Opendoor Technologies Inc., ticker symbol OPEN, is currently sitting at $7.64, reflecting an intraday movement of a drop by $0.13 or approximately minus 1.64% as of 9:58 a.m. EDT on this Monday, November 3rd, 2025 trading day. Now, you might be looking at that small slip today and think it's just general market noise or a minor profit-taking session after what has been a truly aggressive run-up from its 52-week low of $0.51. However, the real story, the one that's going to make you pause your daily scroll through the headlines, is the subtle yet powerful shift happening beneath the surface of the trade volume, a development that absolutely nobody expected 6 months ago. The common narrative on Opendoor, particularly across various online investment discussions and even amongst some analysts you find on investing sites, is that it's a hyper-cyclical, interest rate-sensitive creature of the post-pandemic housing boom, a narrative which thought absolutely hammered as the Federal Reserve raised rates. The expectation, the reality most people held, was that Opendoor would simply bleed cash and be forced into a dilutive restructuring, or even worse, unable to maintain its highly leveraged inventory model in a world of expensive capital. The unexpected twist, the element that creates the tension between that expectation and the current reality, is the quiet but persistent institutional accumulation that has been layered into the stock's recent ascent. Forget the daily price swing for a moment. What truly matters is the change in who owns the float. While the last quarterly institutional filings, which are always a bit of old news by the time they are public, showed significant reduction in holdings from major players like BlackRock and Vanguard Group Inc., a closer look at more recent data and trading patterns suggests a counter-narrative of new or increased positions from smaller, more nimble hedge funds and quantitative shops. Specifically, firms like Two Sigma Advisors and Cube Research and Technologies have significantly increased their stakes, which suggests they see something fundamentally different than the old guard who cut their positions. This shift is not about the housing market recovering yet. It's about a belief in management's capability to operate in this difficult market, a contrarian perspective that challenges the general consensus that the iBuying model is inherently flawed. The smart money isn't necessarily betting on a quick return to peak housing volume. They are betting on Opendoor's ability to transition its model, to cut its operating expenses with surgical precision, and to leverage its technology stack to survive until the macro environment improves, moving towards a less capital-intensive structure. The day's dip, then, is a perfect reflection of that tension. You see the immediate, visceral reaction to any negative pressure in a stock that has quadrupled from its lows, traders who piled in on the momentum selling off the first sign of weakness. Yet the overall volume, currently tracking well above the average, tells you the stock is absolutely a focus point. This massive volume, coupled with the stock trading in a tight $7.50 to $7.76 range in the early hours of market activity, points to an ongoing significant tug-of-war. The bears are using the broader real estate sector's woes and the upcoming earnings report on November 6th as a catalyst for a short attack, while the newly entrenched institutional players and speculative retail buyers, often active on platforms like Robinhood, are aggressively defending a technical support level. The recent trading action, especially over the last few weeks of October, showed the stock finding a surprising stability around the $7.30 mark, even as analysts from major banks maintained low price targets, a move that is deeply contradictory to the price action. The general belief is still anchored in a sub-$5 valuation, but the market reality is open as holding firm substantially above that, forcing a reevaluation for anyone using those lowball analyst reports for their online investing strategy. We need to be asking ourselves, is this resilience purely speculative, or is there a genuine operational improvement that the broader market has missed? To truly appreciate this tension, we need to understand the core business model, what Opendoor Technologies Inc. actually does. Their core function is iBuying, or instant buying. They operate a digital platform for residential real estate, giving homeowners the ability to receive a cash offer for their home online, sight unseen, allowing for a fast and certain transaction. Opendoor then takes on the risk of owning the home, makes necessary light repairs or improvements, and then resells it. Their goal is to profit from the spread between the buy price and the sell price, plus a service charge, all while turning over inventory as quickly as possible, what they call the margin and speed formula. This is a complex logistical and capital-intensive business, and the history is what gives the skeptics their ammunition. Past reports, particularly at the peak of the housing market mania, when they were overpaying for homes to secure market share, show massive write-downs. As interest rates soared and the market froze, houses sat on their books longer, carrying significant holding costs and necessitating steep price cuts, resulting in heavy net losses, which is why the stock price plummeted. However, the reality today is that the company has spent the last year aggressively right-sizing its inventory and its cost structure. The new leadership, with co-founders returning to the board and an announced focus on operational discipline and a capital-light model, is the key catalyst attracting the contrarian institutional money. Their shift towards an agent partnership model in some markets, where they act more as a transaction facilitator that provides a cash offer to a seller listing with an agent, is a clever way to capture revenue without the massive balance sheet risk of owning the property outright. This hybrid approach is what some investors, perhaps those using interactive brokers trading platforms for their aggressive portfolio adjustments, are now seeing as a path to profitability that reduces their exposure to inventory depreciation. It's a move from pure speculation on home appreciation to a focus on efficient, high-volume transaction fees, a much more sustainable model. Let's look more closely at the recent trading movement dynamics. The trading volume we are seeing today, which is tracking well above the average, highlights the speculative nature of the stock, but it also reflects its inclusion in various thematic ETFs, including some of the Fidelity ETFs that focus on technology and real estate innovation, and certainly the attention it gets on platforms like Robinhood. The high volume isn't just retail, it's the professional short sellers attempting to manipulate the price downward ahead of earnings, and the large buyers, the institutions, countering that pressure. The tension is palpable. The stock's beta, its measure of volatility, is typically quite high, meaning any movement in the broader Nasdaq or the housing market gets amplified in Opendoor stock. This high volatility is exactly what attracts a specific type of trader, those who thrive on outsized swings, and it's a characteristic that makes it unsuitable for conservative approaches like Schwab Intelligent Portfolios. For individual brokerage accounts with a higher risk tolerance, however, the volatility is the feature, not the bug. The upcoming earnings report on November 6th is now the single most important event on the calendar. The market has an expectation, a narrowed but continued loss, as high mortgage rates suppress transaction volume. The reality that will exceed this expectation, the thing that will send the stock soaring past the consensus price targets, would be any indication of a positive adjusted EBITDA, a significant beat on the number of homes sold, or most importantly, a substantial improvement in the contribution margin per home, indicating their pricing algorithms have stabilized and their cost reductions are truly sticking. Now, for a brief look back, Opendoor went public via a SPAC merger, a method that, historically, often leads to periods of extreme volatility and a tendency to underperform post-merger. Its spectacular rise and subsequent collapse during the pandemic market frenzy is a classic study case in speculation over substance. But for all the past missteps, the company has successfully built a functional, large-scale real estate platform, which is no small feat. The technology behind their instant offer, the proprietary valuation models they employ, and the logistics network they have built to manage a massive real estate portfolio, these are all significant assets that a company like Zillow tried and failed to replicate. Their old performance was characterized by chasing volume at the expense of margin. The new focus, as evidenced by a smaller, healthier inventory and a stricter pricing model, is on margin before volume. This change in philosophy, moving away from being a tech-enabled speculator to a true real estate operations company, is what the institutional money is likely betting on. Looking ahead, the future outlook for Opendoor Technologies Inc. hinges on a few critical factors that feed directly back into our expectation versus reality framework. Expectation: the housing market stays tight, rates stay high, and Opendoor continues to burn cash until they're forced to raise more capital, diluting shareholders. The reality to watch for: first, the earnings call must demonstrate a continued and verifiable trend of cost cutting. Management must show, not just tell, that they are operating more efficiently than ever. Second, any signal from the Federal Reserve that a rate cut cycle is on the horizon would be an immediate massive catalyst, as it would release the pent-up demand in the housing market and validate Opendoor's fixed cost reduction strategy. Third, the success of their capital-light partnership channels is paramount. If they can show substantial, profitable revenue from non-iBuying sources, it fundamentally de-risks the entire investment thesis. They're already demonstrating an ability to adapt, which is a key trait of a truly durable business, not just a cyclical speculator. The risk, of course, is that a major